Welcome to Financial Assets. In the previous chapter, we noted that companies raise capital in two main forms, debt and equity. Now, in this chapter, we examine the characteristics of bonds and discuss the various factors that influence the bond prices. Before anything else, let us just define what is a bond. Now, a bond is a debt security under which the issuer owes the holders a debt and is obliged to pay them interest or to repay the principal at a later date. Now, interest is usually payable at a fixed intervals. Now, a bond has a lot of characteristics. Now, let us examine the different characteristics of a bond. First off, we have here the par value. Par value is the face value of the bond and is the amount of money that the bond will be worth at the maturity. Now also, it is a reference amount by which the bond issuer uses when calculating interest payments. Second, we have here the coupon interest rate. Now this coupon interest rate or the coupon rate is the interest rate that the bond issuer will pay based on the par value. Now, this coupon interest rate will be paid on a fixed interval. Next, we have here the maturity date. Now, the maturity date is the date on which the bond will mature and the bond issuer will pay the bondholder the face value or the par value of the bond. Next is issue date. Now, the issue date is the date on which the bond was issued. Next, we have here the yield to maturity. The yield to maturity is the internal rate of return required for the present value of all the future cash flows of the bond. So basically, this is the face value and the coupon payments, which would equal to the current bond price. Now, let's have an example of a bond problem. Now, on January 5, 2013, XYZ Incorporated issued 10,000 bond with a coupon rate of 8% that matures in 10 years and is priced to yield at 6%. Now here, let us identify which is or what is the par value here. Now first, the par value is the 10,000 pesos. Now the coupon interest rate here is, as stated in the problem, that is the 8%. While the maturity date is the 10% and the issue date is the January 5, 2013. And lastly, the yield to maturity here will be the 6%. Now we have two main types of bond. That is the corporate bond and the government bond. Now, a government bond is being issued by the government or the federal state, while the corporate bond is being issued by large businesses or corporation. Now, another difference between the government bond and the corporate bond is that the government bond entails lower risk than the corporate bond. Why? Because the corporate bond is giving its bondholders a higher return. Now again, going back to the basic principle of finance, the higher the return, the higher the risk, or the higher the risk, the higher the return you would get from that investment. So basically, the government bond, considering that it has a lower risk compared to the corporate bond, so definitely it would have a lower return compared to the corporate bond. Now let us examine how to compute the bond price. So in order for us to know that, we should know the formula for the bond price. Now the bond price formula is as stated. Now bond price is equal to the coupon rate or the coupon payment, that is the C, multiplied by 1 minus 1 plus r to the power of negative n all over r plus f, which is the par value, all over 1 plus r, again r is the required rate of return, multiplied by n, or the number of years or period. Now basically, the bond price would equal to, if you can still remember the topic about the time value of money, PVM, this formula here is the present value formula. Now, we are going to get the present value of the cash flows, PV of the coupon payment, okay? And then add up the FV, or this is again the of future value of the principal amount. Okay. Now let us try to solve a sample problem of the bond price. Now the problem says you intend to purchase a 10-year, $1,000 face value bond that pays interest of 6% annually. Now, if your nominal annual required rate of return is 10%, how much should you be willing to pay for this bond? So before we solve this problem, we will first identify the different characteristics that is included in this problem. So first, we first identify the coupon rate, that is 6%. And then let's have the face value, which is 1,000. And then the N, or the period, that is 10 years, and the rate of return, or the required rate of return, is 10%. Okay, so basically these factors, or these characteristics, will be enough to solve for the problem. Now again, our formula for the bond price is coupon payment, so that is this, and then 1 minus 1 plus r to the power of negative n all over r plus f over 1 plus r to the power of n. Now, to solve for this, let us substitute this one into figures. Now, first off, the coupon payment. So that is 60. Why? Because, again, that is 6%. What is 6% of this 1,000? We are talking about here the coupon payments and not the interest rate or the coupon rate. So basically, 6% of 1,000, that is 60. And then 1 minus 1 plus 0.10, that is the required rate of return, to the power of negative 10, that is your end period, or the period, all over 0.10 plus the face value, which is 1,000, okay, all over 1 plus 0.10 to the power of n. Now, to solve that, we have here the bond price of 368.67. That is the present value of the cash flow, or the present value of the coupon payments, plus 385.54, which is the future value of the principal amount. Now add it up, we have here a bond price of 754.21. Now, the bond price are selling at a discount. Why? Because the 754.21 is lower than the 1,000. So basically, when a bond is being sold as at a discount rate, meaning to say, the bond price should be lower than the principal amount. So just like here in this problem, 754.21 is lower than the 1,000 face value. Now let's have another example for the computation for the bond price. Now in this example, we have here the R, or the required rate of return, is lesser or lower than the interest rate or the coupon payment. Now, the problem says you intend to purchase a 10-year, $1,000 face value bond that pays interest of 10% annually. Now, if your nominal annual required rate of return is 6%, how much should you be willing to pay for this bond? So basically, this problem is just similar from the previous slide, but the interest rate and the required rate of return rather was or is already switched. So from 6% coupon rate, it is already 10%, and the required rate of return of 10% from the previous slide was already changed to 6% in this problem. Now, the formula for this again is bond price is equal to the present value of the cash flows, or that is a coupon payment, plus the future value of the face value or the par value. Now here, to compute for the bond price, the coupon payment here is already 100. That is because 1,000 multiplied by 10%, which is the interest rate, so that is $100, multiplied by the present value factor, and then add up the future value factor of the face value. So we have here the present value of the coupon payments is 736.01, while the future value of the face value or the par value is 558.39. Now, since add this up, we can get a bond price of 1,294.40. Now here, since 1,294.40 is greater than 1,000, so basically our bond price here, or the bond here, is being sold at a premium. Okay, so as the opposite of the previous slide, the bond price there was sold at a discount, considering that the bond price that we have computed is lesser than the 1,000 face value, while here the bond price is being sold at a premium, considering that the bond price is higher than the 1,000 face value or par value. Now for the third example, we have here the rate of return is equal to the interest payment. So let us see what happens to the bond price. Now same example, but the interest rate and the required rate of return is already the same with 10% annually. Okay. Now again, the formula for the bond price, that is the present value of the coupon payments plus the future value of the face value or the par value. And then to substitute, we have here again a $100 of coupon payment. So multiplied to the present value factor plus the future value factor of the face value. And then we get here a 614.46 plus 385.54. Add that up, so we have a bond price of 1,000. Now, 1,000 bond price is now equal to the par value of 1,000. So basically, our bond price here, or our bond here, sells or being sold at a par. Okay? When a bond price, or when the bond is being sold at a par, the bond price equals to the face value of the bond. Now here is the summary of the interest rate changes and the bond prices. Okay, so if the case is that the required rate of return is greater than the I, or the coupon payment, or the interest rate, then the effect on the bond price is that the bond price is lower than the par value. So basically, the bond sells at a discount. while if R, or the required rate of return, is lesser than the interest rate or the coupon rate, the bond price will be higher than the par value. So basically, the bond will be sold at a premium. While if the required rate of return is equal to the interest rate or the coupon rate, the bond price would also be equal to the par value. So basically, bonds will be sold rather on a par. Now let us have another example of the bond price computation with a semi-annual coupon payment. Now here is the problem. So you intend to purchase a 10-year $1,000 face value bond that pays interest of $60 every month, or every 6 months rather. And if your nominal annual required rate of return is 10% with semi-annual compounding, how much should you be willing to pay for this bond? Now, this problem is basically the same with the previous problem, but the difference is just the coupon payment, which is being paid every 6 months, or basically semi-annual. Now here again the formula for the bond price, that is the present value of the coupon payments plus the future value of the face value or the principal amount. Now here the bond price or the coupon payment rather is 60, considering here it is already stated that the bond will pay the bondholder $60 every month. So 60, and then the present value factor is computed this way. So again, based going back to the time value of money discussion, when we have a semi-annual problem for the time value of money, the rate or the interest rate here, or the rate of return here, will be divided by the number of periods in a year, and then your n here, or your period here, will be multiplied by the number of periods within a year. Now here, since we are having a semi-annual coupon payments, we have here 1 minus 1 plus 0.10 over 2, because it's semi-annual, to the power of negative 10 times 2. Okay, so all over 0.10 over 2, and then for the future value of the principal amount, that is 1,000 divided by 1 plus 0.10 over 2 multiplied by, or to the power of 10 times 2. So here, our bond price, the present value of the coupon payments is 747.73 plus the future value of the principal amount, that is 376.89. So our bond price here is 1,124.62. So here, since 1,124.62 is greater than the par value of 1,000, so basically this bond is being sold at a premium. Now let's go to the bond yield. Now, a bond yield, unlike the coupon interest rate, which is fixed, the bond's yield varies from the day to day depending on the current market conditions. Now, the yield can be calculated in 3 different ways, and 3 answers can be obtained here. First off, we have here the yield to maturity. Now, a yield to maturity can be viewed as the bond's promised rate of return. So, basically, this is the return that the investors will receive if all the promised payments are made. Okay, so this yield could be computed, or this yield is the return after its maturity. Okay, second, we have here the yield to call. Now, if you purchase a bond that was callable, meaning to say it is a redeemable bond, which is a bond that the issuer may redeem before it reaches the stated maturity, so you would not have the option of holding the bond until it is matured. So that is why it is being called a callable bond. Now, therefore, the yield to maturity for this would not be earned. So that's why um, we can only have the yield to call for this. Lastly, we have here the current yield. Now, the current yield is the annual interest payment dividend or divided by the current bond's current market price. Okay, so basically the current yield is interest payment divided by the bond's current market price. Now, since we already know the different types of bond yield, we will now be discussing how to compute those bond yields. So we will have here the bond yield formula. So first off, we have the yield to maturity, that is the coupon payment plus the face value minus the price divided by the number of years all over face value plus price divided by 2. Next, we have here the yield to call, that is the coupon payments plus the call price minus the market price divided by the number of years to call all over face value plus market price divided by 2. So basically, the yield to maturity and yield to call is similar, but the difference is that the yield to maturity is basing on the factors um, of the face value and the price, while the yield to call, the factors that are included here are the call price and the market price. And lastly, we have here the current yield, that is the annual coupon payment divided by the current bond price. Now, in the succeeding slides, we will be computing for different examples for the different bond yield. Now, let us have an example problem for the yield to maturity computation of the bond yield. Okay, so the problem says the $1,000 face value of EFG bond has a coupon of 10% that matures in 4 years and has current price of 1,140. Now, what is the EFG bonds yield to maturity? Now here, before we start to compute for the yield to maturity, let us first identify the different factors of this problem. So we have here the face value, that is the 1,000 face value of the principal amount, and then we have here the coupon of 10%. So basically, the coupon payment here is 100, and then it matures in 4 years. So N here is 4 and has a current price, or let's just say price, of 1,140. Now, going back to the question, what is the EFG bond yield to maturity? Now, first, let us examine the formula, or let's take a look back of the formula for the yield to maturity. Now, the formula is the coupon payment plus the face value minus price over or divided by the number of years all over face value plus price divided by 2. Now, to substitute these factors, we have here the yield to maturity is equal to the coupon payment. Again, that is 10% of 1,000. So we have here a coupon payment of 100 plus the face value of 1,000 minus 1,140 as the price divided by the number of years, that is 4, all over 1,000 plus 1,140 divided by 2. So to compute that, we should get the answer of 6.07%. Now, looking back to this problem, we have here the yield to maturity of 6.07. Now, the coupon payment here is 10%. Now, if we can observe, 1,140 is greater than the 1,000. So basically, this bond is being sold at a premium. Okay. And again, if we will go back to the table that shows the effect on the changes in the interest rate and the bond premium, we could say that 6% here is lesser than the 10%, which is the coupon rate. So the 6.07% here is the required rate of return, and then the 10% here is the I. So basically, when the rate or the required rate of return is lesser than the interest rate or the coupon rate, the bond is being sold at a premium. Okay, so let's have another example for the yield to maturity, but here in this example, we will be having a semi-annual coupon payments. Now, the problem is just the same with the previous slide, but here, again, the difference is that the coupon payment or the coupon payment is being paid semi-annually or every 6 months. Now, to compute for that, again, the formula, that is coupon payment plus the face value minus price all over the number of years divided by the face value plus price divided by 2 multiplied by 2. So here, since our coupon payment again is 10% of 1,000, that is 100. So since we are paying it on a semi-annual basis, so 100 divided by 2, that is 50, plus 1,000 minus 1,140, that is the face value minus the price divided by the number of years. So 4 multiplied by 2, considering again that is semi-annual basis, all over 1,000 plus 1,140 divided by 2 multiplied by 2. Okay, so here if you compute that using your calculator, you should get the yield to maturity of 6.07%. So basically that is just the same with the previous slides, considering that here the coupon payment of 10% was only divided by uh by 2. So basically the coupon payment that is being paid here is only 5% and not the 10%. Okay, so that's it. So now let's have a sample or an example of the bond yield for the yield to call. So in this problem, it says that consider a callable bond that has a face value of $1,000 and pays an annual coupon payment of 10%. So the bond is currently priced at $1,175 and has the option to be called at $1,100 5 years from now. So before we answer the problem, let us first identify the different factors that are included in this problem. First is that we have here the coupon rate or the coupon payment. So that is 10% or that is 100 because that is 10% of 1,000. Now, another thing is that we have here the market price, or again, in the problem it says the bond price is currently priced at 1,175. So that is 1,175. Next is that we will be having the callable price, that is 1,100. And lastly, we have here the N or the number of years to call, that is 5 years from now. Now, let's have the formula for this. So we have here the coupon payment plus the call price minus the market price divided by the number of years to call all over face value plus market price divided by 2. Now here, the yield to call, to substitute it into the numbers, so the yield to call here is 100, that is the coupon payments, plus the call price of 1,100 minus the market price of 1,175 divided by the number of years to call, that is 5, all over 1,100 plus 1,175 divided by 2. Now, the yield to call here is 7.74%. Now let's have another. So for the last bond yield or type of bond yield, we have here an example for the current yield. So the problem says that consider a $1,000 par value bond with a 7% annual coupon. The bond pays interest annually. So there are 9 years remaining until maturity. Now, what is the current yield of the bond, assuming that the current price of the bond is 827.23 with the required rate of return of 10%? So basically, when we are looking for the current yield of a bond, we are only looking for the annual coupon payment, or the coupon payment that is 7% or 70. That is 7% of 1,000 or $70. And then the current bond price, okay? The current price, so that is 827.23. Now let's have the formula for this. Again, current yield is equal to the annual coupon payment divided by the current bond price. Now, current yield is equal to 70, that is the annual coupon payment, divided by the current bond price of 827.23. So a total of 8.46% current yield. Now, aside from the general bond price that we know, we also have the clean bond price and the dirty bond price. So what is the difference between the two? Here, the clean bond price or the clean price is the price of a coupon bond not including any accrued interest, okay? So there is no accrued interest in the clean price. While um, the dirty price is the price of a bond that includes accrued interest between coupon payments. Okay, so as you can see in the illustration, the dirty bond price has an accrued interest between the coupon payments of its computation, while the clean price, which is the long straight line, that is just the clean price without any accrued interest in it. Now let's have another example for the dirty bond price and the clean bond price. So the problem states that a bond pays a coupon of 7% and matures in 2015. Then the coupon is paid semi-annually on the 1st of January and the 1st of July. The bond is sold for 96.5 that was valued on the 30th of March 2011. So before that, we will first know the formula on how to compute for the dirty bond price. So that is, dirty bond price is equal to the clean price plus accrued interest. Now, to solve for the accrued interest, we have here the interest rate or the coupon rate multiplied by n over 365. So let's compute for the accrued interest. So that is um, the interest is 7%. So since we are paying it semi-annually, so we will divide it by 2 multiplied by n, that is 88 over 365. Now, why is it 88? So since the interest rate should be paid on the 1st of January, so basically this 88 should comprise, or the accrued interest here should be from January 1 up to March 30. Okay, so since for January we will compute the days for the accrued interest, so from January we have 31 days, for Feb we have 28 days, and for March we will only use 29 days, considering that the bond was already bought on March 30. So from March 1 up to March 29. So add that up, we will get 88 as our n. Okay, so when we compute for this, we can solve, okay, use this as 7%, so we will be able to solve for 0.008438. Okay, but so since we are looking for the accrued interest, okay, not the interest rate, So we will be multiplying it to the par value. Now, if you can observe, there is no par value that was indicated in the problem. Okay, so since the price of the bond is 96.5, meaning to say our par value here should be 100. Okay, so when the problem is silent about the par value, you look at the bond price. Now, if the bond price is on hundreds, so basically hundreds or near 100, basically the bond price here or the principal value here is 100. But if the bond price is near thousands, okay, so basically the principal value here is 1000. So here in the problem, our bond price is 96.5. That is near 100. So we assume that the par value here is 100 multiplied by 0.008438. So that is 0.8438. Okay, so now we already have our accrued interest, so we can now solve for the dirty bond price. So dirty bond price, we have here the clean price, that is the 96.5, plus the accrued interest of 0.8438. So our dirty bond price here is 97.3438. That's all for the bond and bond valuation. So I hope you learned something from the discussion, and I hope you study this topic for the semifinals and the final exam. Okay? Thank you.